Kia ora, welcome. My name's Andrea Black. I've had the very great pleasure of working with our key presenter today, Nick Miller at Inland Revenue, pardon me, during my 20 years or so as a tax specialist, including with Inland Revenue. Now, during that time, I was the Principal Advisor for International Tax, and I focused on cross-border transactions that didn't involve transfer pricing, which was very much Nick. So I did a lot of things that Nick didn't do. I'm currently economist at the Senior Doctors Union, the Association of Salaried Medical Specialists, and was previously the independent advisor to the Tax Working Group. I will be your MC for today. I am also the treasurer for 350 Aotearoa, which is a member of the Better Taxes Coalition with Tax Justice Aotearoa. I'm here to welcome you to the third of Tax Justice Aotearoa's Tax on Tuesday session. Today, this session, led by Nick, will focus on corporate taxation, both taxation of domestic companies and multinationals from the big tech sector. The last two sections of the series will be on wealth and wealth transfer taxes on the 11th of August and how New Zealand's tax settings and risks compare to other countries. Now, for today, we get to hear from our main speaker, Nick Miller, who's a Tax Justice Aotearoa Policy Advisory Committee member. That will take about 20 to 30 minutes and will be in the form of a Q&A between me and Nick. And then we've got the pleasure of hearing from Professor Paul Dalzell as a commentator on Nick's session. He will reflect on why corporate tax needs to be done better and what we can learn from what we've heard from Nick. Then there'll be an opportunity for questions, so please put your questions in the chat and I'll pick them up at about 1:15 and we'll close off at 1:30. Now, before I start, just like to remind everyone that Tax Justice Aotearoa is the lead organisation in the Better Taxes for a Better Future campaign. The campaign is supported by a coalition of around 25 organisations, which does include 350 Aotearoa, but has yet to include the Association of Salaried Medical Specialists. Watch this space, I'm working on that. And it's they're campaigning for a tax system that will enable us to gather resources to fund the things that matter and to do it more fairly. And the final plug, for those who aren't ready, we'd love you to get involved and support this mahi. We'll post some links in the chat for you to sign up and donate. Now, in April this year, Tax Justice Aotearoa released its tax policy statement. It set out its policy for reforming our tax system and builds on a set of principles that underpinned its approach to tax reform. That is the need to gather more revenue, the need to make the gathering of the revenue more fair, the support of tax for means for supporting positive behaviours in areas like public health, go public health, and environment, go environment, and the need for greater transparency. This tax policy statement moves beyond the principles to provide a benchmark that can be used to assess the tax policies of political parties and other interested groups. But it's very much not the last word on tax, rather it sets a direction and will evolve over time. Now, our speakers. Nick is an international tax expert who's worked as a technical specialist at Inland Revenue, and before that spent over 20 years in Her Majesty's Revenue and Customs, that's the UK. There's some other stuff here about Nick, but I would like to give him a big plug for the man that led the banking tax avoidance cases in the early 2000s or so. He came over here on a sort of secondment from HMRC for a bit of a, debrief R&R break to Inland Revenue, New Zealand with his family, and found himself leading one of the most complicated and fraught audits that I think the Revenue has ever seen. Also has an interest, back to my lines, also has a particular interest in transfer pricing and corporate tax avoidance. Yes, let's see the work he did in the banking cases 20 years ago. And is the author of Big Tech, Little Tax, recently released. Our other speaker is Paul Dalzell. Paul Dalzell was a professor of economics at Lincoln University until his retirement in 2024. He's now a research economist at the Wellbeing Economy Alliance Aotearoa, also known as We All, and he's the lead author of Wellbeing Economics, published in 2018. Right, now the real stuff. I'll now turn to Nick to talk about Tax Justice Aotearoa's policy on corporate tax. The process is going to be Nick will pick up a slide, he and I will have a bit of a chat, and then we'll move to the next slide. Off you go, Nick. Welcome.
Kia ora kutu. Thanks, Andrea, and thanks everyone for joining us. Can we have the first slide? Can everyone see that? No?
I think I can just see me, which as attractive as that is not as useful as your slide.
Aha, here we are. So what I wanted to do, first of all, is to just have a look at the big picture on corporate tax. And this first slide is simply a lift from the Inland Revenue's latest annual report. And what we can see is that corporate tax produces 17% of tax revenue, nearly $20 billion. Interestingly, that 17% is actually greater than the OECD average, which is about 12%. So we rely actually more on corporate tax than a lot of our peer countries in the OECD. I think another thing to note here is that every 1% cut in corporate income tax would cost $700 million. So I just did a little bit of a sum on this, and cutting to the global minimum of 15%, which is where Ireland is now, would cost around $9 billion a year. So that money would have to be found, if we were to do that, which is sometimes suggested, that money would have to be found from somewhere else. Also important to note, if we're looking at the big picture, is that the corporate tax rate in New Zealand is not particularly high compared with peer countries. We're at 28%. The OECD average is over 24%. Interestingly, the G7 average is 28%. And of course, Australia next door is 30%. So cutting the tax rate is very expensive, and not a great deal of evidence that it moves the dial unless you cut to Irish levels and then, as Ireland did, allow yourself to be used as a conduit and tax haven with that 12% rate. Also noticeable, if we're talking about Ireland, that it has a much more progressive income tax system. It has 20% VAT, it has capital gains tax, capital acquisition tax, etc. So we're not really comparing like with like. What could make a difference, for example, if we were to increase the corporate tax rate, is to increase the number of targeted incentives, for example, to, as some countries have done, large super deductions for R&D expenditure. Denmark is one example of that. New Zealand's subsidy rate for R&D is about at the OECD average, but there's an argument that there's a bit of catching up to do. And some countries also have patent box regimes. That is, if you develop intellectual property in the country, then you might have a reduced tax rate on the income from that intellectual property. That might be useful here, I think, because it might act as an incentive for New Zealand companies that develop IP here to retain it rather than sell it offshore with no capital gain. So these measures are likely to be less costly than cuts across the board, for example.
Thanks for that, Nick. Now, I note is that the corporate tax or the company tax take you've got there of 19.7 billion will include a lot of closely held company taxation, given that with a tax rate of 28% and a top tax rate of 39%, there's a preference to leave money in a company or to earn money through a company. Do you have any idea how much of that corporate tax is closely held versus multinationals?
I don't off the top of my head, but you could, for example, we know that, for example, the banks pay about 2 billion. I think multinationals are going to account for another few billion of that, but yes, probably the majority of it is probably going to be closely held companies.
Right, which then makes the case for taxing foreign companies higher. Yeah, shall we move to the next slide?
Sure. So one of the ways in which companies, particularly multinationals, minimize their tax is through interest deductions. For example, if they were to buy a New Zealand business, they might do that through a highly leveraged takeover, introducing lots of debt into New Zealand. We see that quite a lot in overseas takeovers. And of course, we have thin capitalization rules to deal with that. But they're quite complex and not always particularly effective in dealing with high interest rates, because thin capitalization rules generally tend to look at amounts of debt rather than the overall amount of interest that's being paid. And the OECD looked at this back in when it was undertaking its first base erosion project back in 2015. And what it recommended was that countries could introduce fixed ratio interest limitation rules. What that means is that a company would only get a deduction for a fixed amount of interest compared with its earnings before interest, tax, depreciation, etc. Usually that's fixed at about 30%. And this restriction on interest deductions has been widely adopted. You can see in the chart there that the fixed ratio has been adopted by about 30 countries. That might be out of date now. I think there are more adopting almost every year. And the thing about these rules is they are very simple to apply. They can operate alongside thin capitalization rules that look at the overall level of debt. They can also restrict third-party debt, as well as debt that has been acquired from an associated party, for example, in a group situation. So they can have the effect of preventing highly leveraged buyouts, for example, just preventing companies deducting a large amount of interest and reducing their tax payments in New Zealand because of that. So it's something that we highlighted in the tax policy statement as a measure that could be introduced in New Zealand, particularly as we have quite complex thin capitalization and interest limitation rules now. That would actually be a simplification.
Okay, so just to kind of clarify, so New Zealand at the moment has a combination of thin capitalization rules which limit where interest deductions or debt deductions start to be denied when the debt to assets or debt to equity ratio goes over a certain percentage. And what you're suggesting here is with the fixed ratio interest rules, it would be a percentage of interest that would be allowed compared to the profit? Is that
exactly? Yeah. That is exactly how it would work. The problem with the thin capitalization rules, as you say, they look at a ratio such as debt to assets, but they do not look at the overall level of interest being paid. So you might have interest which is at a particularly high rate. So restricting it in this way is potentially more effective than relying on a thin capitalisation regime alone, and that is why I think a lot of countries have adopted it, including the likes of Australia and the United Kingdom.
And would this be just for multinational companies, or could it be owned? Could it also be New Zealand-owned companies who are, or you know, I mean, to me, it seems like it could also work with closely held companies where there's a private work split thing going on with the company, and all the interest deductions are going into the company and all the equity is with the proprietor. Do you have a view on that, or is it just something that could work for multinational companies?
No, I was thinking about this. I think it could work. It could definitely work with closely held companies, because one of the problems with closely held companies is potentially the amount of debt they take on, and that obviously reduces their profits, but also makes them financially unstable and obviously then potentially subject to collapse or liquidation. So a measure which restricted the amount of effectively the debt they could take on could be beneficial in more ways than just increasing the tax take.
Okay, look, thank you. Should we go to the next slide?
Yes, one of the other areas we looked at in the tax policy statement was the case for surcharges or excess profits taxes. What do we mean by excess profits? We mean profits which are greater than one would normally expect in a normal commercial environment. For example, if there's larger profits because of a lack of competition, I mean, that would be one example of that. And of course, the one that everyone thinks of is the banks. And do the banks make excess profits? There's quite a lot of evidence that they do. This chart is simply looking at the bank profits reported by the Big Four from their annual disclosure statements. And we can see that there's certainly for at least one of the banks, and to a lesser extent for the others, there's a pretty steep rise in profits over time. And interestingly, if you compare it with the performance of the parent banks in Australia, the profits in New Zealand are going up by a far greater amount. And the reason for that is not difficult to ascertain if you delve into the disclosure statements, because the New Zealand banks are the interest differential, the difference between what they pay for funding and what they charge to customers is far greater in New Zealand than it is in Australia. So there you have the beginnings of what could be measured as the excess profit. But it's not. I wouldn't say it's a straightforward thing to measure, but certainly there's the evidence there that there's a case for an excess profits tax, or potentially a surcharge, as they have in the United Kingdom. United Kingdom has an extra has a tax rate of an extra 3% on banking profits, and I mean that's an example of potentially what could be done.
Oh no, that's interesting, Nick. Thank you very much. Next slide.
We also looked in the policy statement about windfalls. Now, this is different from excess profits because it's a one-off, not a systemic differential in the amount of profits being made. It's something that just happens in a given year, probably not due to the actions of the company itself, but something they're able to benefit from. And sometimes the windfall is quite visible. And this chart comes from the MB fuel price figures that are published weekly, showing the amount of cost to the importer, the fuel companies importing the 91 petrol in this case into New Zealand, and the pump price. And this shows the position at the start of the Middle Eastern crisis back in February. And we can see that the retail price the pump price went up immediately, as we all know, but the importers were still able to use their inventory of 4 or 5 weeks of much lower priced fuel, and that was for about 4 or 5 weeks a significant windfall. And you can see the gap there. That's quite an increase in the gap right at the start of beginning of March, I think, and then starts to tail off about a month later, as you'd expect, as the lower priced inventory runs out. Now, you sort of would expect that would unwind as the crisis subsides, but it never seems to do that. You don't seem to get that mirror image at the other end of the cycle. What you get is a much more gradual return to normal. So genuinely, there is a windfall there, and it's probably not too difficult to measure.
Okay. And so would you be suggesting sort of a one-off tax, a bit like, Blair did all those years ago on the banks and privatised industries?
I think it would be a one-off tax because it's a one-off event. So that would make sense. It's probably a one-off tax on the additional, effectively the windfall that you can see in that chart. I mean, one of the things that is potentially an issue here is that, of course, those importer costs that MB report, which are the basis of the blue line in the chart, are reported market costs, the costs reported on, for example, in Singapore, but it may not necessarily be the cost that the importers are actually paying, because they actually buy their fuel from associated parties, other companies in the group. So it's possible that excess profit never actually gets reported here, even though they've made it, and that's a transfer pricing issue. But in general, yes, it would be a one-off levy on the that 4 or 5 weeks of super profits that you can see there.
Now, the windfall tax and also possibly an extra tax on the banks, is there a risk that falls foul of the anti-discrimination articles in the treaties? Because at least when, I know the UK did it, they were doing it to their own domestic companies, but here we would be doing it to foreign-owned companies that would have treaty protection. Is that an issue, or should I have given you that question before I started, Nick?
Well, I guess in theory it might be, but I mean I don't think it would be discriminatory if it was imposed across the board, which I think it would have to be. So there are importers that are New Zealand owned as well. Okay. And I think obviously, the vast majority of the fuel imported is by multinational companies. But if you have a measure that it doesn't discriminate against them, then I don't think the treaty non-discrimination clause would be an issue.
Yeah, no, that seems fair. And I mean, we do sort of have a bit of a New Zealand-owned banking system too. So Kiwi Bank could also wear that cost.
Well, and also it's yeah, I think these measures definitely would have to be applied across the board. But the thing is, excess profits are only appear to be an issue for potentially not even maybe all of the big four banks, but certainly at least one of them, and maybe more than one of them. I think the important thing is that it is not aimed specifically aimed at foreign-owned companies.
Okay, thank you for that. We'll move to the next slide.
Yeah, this takes us on to I think enforcement, and one of this comes from this quote comes from the Inland Revenue International Tax Compliance Focus in 2024, which basically outlines how they deal with international risks from multinational companies. And this was interesting to me because it sort of implies that, well, it doesn't imply, it says that multinational companies operating in New Zealand, for example, those importing goods, will be expected to achieve quite high margins because of relative lack of competition. That would include companies, for example, importing fast-moving consumer goods, kind of things buying supermarkets, etc. But it doesn't appear necessarily, if you look at the returns being made by these companies in the financial statements which appear in which are disclosed by the Companies Office, that this isn't necessarily happening. That is, a lot of the multinationals are reporting returns on sales which are actually quite modest, even by the standards that Inland Revenue would expect for normal distribution companies. For example, I know of a number of examples of large companies returning returns on sales of less than 3%, which is usually a trigger for an Inland Revenue inquiry. And Inland Revenue's focus since 2019 has largely been, and this is reflected in that document, the tax compliance document, to facilitate compliance among multinational enterprises, multinational companies. I sort of question how effective that's been overall. Multinational companies, groups set their transfer pricing policies globally. They're not really concerned about what Inland Revenue thinks about what Inland Revenue considers they should be doing. And what Inland Revenue don't appear to have done, as much as perhaps I would like to see, is to carry out transfer pricing audit work, because transfer pricing audit work involves a lot of time and resources. It involves reviewing the agreements that multinational companies negotiate between themselves, transfer pricing reports, but it also involves quite proactive investigation work, such as interviewing employees, looking at their email boxes to see what's happening. Because what I found when I was doing investigation work into transfer pricing is that you would be presented with a report that told you certain things were happening on the ground, and then you were going to the mailboxes of employees, for example, and find out something completely different was going on. And I wonder how much of that work is because of this focus on minimizing compliance costs, for example, that Inland Revenue have a big focus on. How much of that work is actually going on in terms of that sort of in-depth investigation work. I don't know, of course, but I would guess that perhaps less of it than perhaps we would like.
Oh, I'm sure that's right. And I have been quite noisy and irritating on that. So I'm 100% behind you on that, Nick. Perhaps we move to the next. Oh, John Canton's. I've largely been just noting John Canton's comments, but OIA-ing the transfer pricing hours sounds like a good idea. Final slide, Nick.
Yeah, this is another one from the Inland Revenue Tax Compliance focus. This sort of illustrates the risk factors that Inland Revenue take into account in deciding whether there's a transfer pricing risk, and it's one of the things I found interesting about this is that I look at some of the companies that disclose their financial statements at the Companies Office, and I see these risk factors in abundance, but I don't see any evidence of any audit work going on, because normally, if there is audit work going on, that's disclosed in the financial statements. So, I mean, that is a concern. I think, I mean, I don't think there's any particular. I don't have any particular beef with the risk factors, but I do wonder in practice how many of these are actually being taken up. When we did the Big Tech Little Tax report, for example, these risk factors were all over the place. But again, I didn't see any evidence of any audit work going on. So this comes back to enforcement. If we're certainly in the multinational space, we do appear to be slightly behind the curve on enforcement. And I compare us, for example, to what's going on in Australia, where there's much more evidence of enforcement activity. They're taking cases. They've had transfer pricing litigation. We haven't had a single case in New Zealand, so there seems to be a reluctance to test the law or to undertake that sort of in-depth investigation, which would then potentially lead to litigation. Australia has had a number of cases over the years. The United Kingdom has. So we're a bit of an outlier in that way, and so this is again a worry that I have, that we're I wouldn't say lax, maybe potentially not able to deploy the resources that we need to have a robust transfer pricing enforcement regime.
Do you think, and this is me, do you think they still have enough people that can do that work, Nick? I mean, left, sure, but there are other smart people in the world.
Yeah, I mean, I think. I mean, they certainly still have some very good people, but I think the kind of resources that you would need to undertake an inquiry that goes all the way to litigation, I mean, you need a combination of economic expertise, investigation expertise, lawyers, and I don't know whether specialising in transfer pricing, and I don't know whether that depth of expertise is there now, and that could account for why we haven't had any litigation cases. So, I mean, that expertise could be acquired, could be bought in,
could be grown.
It could be grown, but you have to invest in training to do that, and quite a lot of in-depth training. I don't know how many people, for example, in Inland Revenue are doing the Advanced Diploma in International Taxation, which is particularly the transfer pricing module, which is obviously an internationally recognised benchmark.
Look, that's enormously interesting and useful. Thank you, Nick. So now I would like to invite our commentator, Professor Paul Dalziel, to reflect on what he's heard and give his views on his issues with corporate tax, both here and internationally.
Kia ora tātou. Thank you, Andrea. I've got 5 comments that I will offer. The first is about the importance of these issues for the well-being economy. So the purpose of tax is to collect resources that can then be allocated for providing public goods and services that benefit everyone. And businesses benefit a great deal from the public goods and services in this country, starting with the legal system that enforces contracts and protects property rights, to the free trade agreements that opens up opportunities on the global scale, to arguably the public health and education expenditure that provides the skilled workforce that are essential for businesses to thrive. However, as everybody knows, there is the issue that if one company is able to reduce its share of the tax contribution, it still gets access to all of those public services, but has more funding to retain. And so we have avoidance activities. There's been a lot of talk this afternoon about transfer pricing amongst closely held companies, for example. And that in turn leads to auditing costs and enforcement costs that Nick finished with. But this is really important to maintain the integrity of the system, to avoid what's called the prisoner's dilemma, where everybody agrees we need a decent amount of tax to fund these public services from which we all benefit, but each individual company has an incentive to reduce their share, and we end up painting ourselves into a corner where we don't have enough of those public goods and services to thrive. And that's where I'll finish in my final comment. 3 comments about some of the details that Nick has covered. One is, it's not just the tax rate, but it's the system design that includes tax subsidies and tax exemptions and tax allowances and so on that impact on the overall tax system. So Nick has mentioned the R&D tax credits, for example, that are relatively recent in New Zealand's history, offsetting some of the imbalance that we've had compared to other countries for a long time. Last year, we introduced Investment Boost, which is accelerated tax deductions for companies that invest in capital equipment, most of which, nearly all of which, would have happened anyway. So it's not getting a large bang for the exemption that is being granted across a wide range. And the budget documents this year showed perhaps no impact on the overall level of private investment. So this would be an example where the questions have to be asked about, is this just aiding some sectors to avoid or lower their tax contributions without the social benefits that really are required to justify that sort of detailed exemption? Another issue that's been raised is the interest rate limitation rules. In the Wellbeing Economy Alliance, we have been concerned about the interest rate deductions that are now allowed to landlords. And the issue is, people say that being a landlord is just being a company, being a business like any other, and so the usual rules should be allowed to apply. The counter argument is that the housing that is being purchased by borrowing debt are people's homes. And so it's different from a factory or equipment or vehicles. Effectively, this rule is allowing the landlord to deduct interest payments from the mortgage, but the individual homeowner doesn't have the same ability. So it tilts the market for buying homes towards landlords and away from homeowners. And we're seeing that. We're seeing the share of people in their 40s and 50s who are living in their own homes falling from above 80% in the 1990 to about 63% now. So that has a big impact on the well-being of people who are being priced out of owning their own home because of this particular exemption that is being allowed to landlords. The fourth one is the excess profits tax and the windfall tax. To be honest, I'm anxious about a suggestion that the government might make ad hoc decisions after an event that, we think you've earned too much profit, so we're going to impose a tax after the event. It would be better to create a systematic policy that this is what we mean by windfall taxes and excess taxes in advance. And then the question has to be asked, is there a similar reciprocal policy when there are excess losses or windfall losses? And that opens up all sorts of questions around the windfall, around the transfer pricing, because it's not hard for a local company to present accounts in which it appears to have made a windfall loss because of the ability it has for transfer pricing and so on. So in the graph that Glenn showed, that Nick showed, profits during COVID fell dramatically. So should there be some recompense for that during the tax system for the excess losses from normal that the four big banks experienced? And finally, I want to go back to the question of how do we collect funds to invest in public goods and services? And one of the huge challenges we face as a country and even as a species is the consequences of the climate crisis. And almost by definition, the climate crisis requires collective responses, setting the rules for mitigation and designing policies and practices, both at the public level and at the private level, to offset and to compensate and to reduce the impacts of the climate crisis, from managed retreat to how do we cope with the extreme storms that are going through various parts of the country regularly now. This is having a huge impact on business. I think it's one of the big reasons that private sector investment has stalled, because people are worried, where do we put our investments given the increasing frequency of extreme weather events and a difficulty in forecasting what that is going to mean and how the government will respond. So given that collective action is essential for mitigation and adaptation policies and practices, where do those costs fall? And how do we find ways to support the collection of revenue to protect wealth? And so I know it's not a topic today, but to my mind, this is a key part of the conversation about wealth taxes, because wealth is under threat from the climate crisis. And if we are to protect wealth, then wealth holders should pay a contribution to those public goods and services. And of the various options for a wealth tax, a capital gains tax potentially imposes the least costs on people because it's realized capital gains. So these are going back to the excess profits. It's a capital gain that gets realized as a version of that same argument. And I think ring fencing a capital gains tax or some other wealth tax to create a fund to address the climate crisis would be an important development in New Zealand's economic system, although the details of that will be left for another day. So I'll hand back to you, Andrea. Those are my 5 comments. I'm very grateful for the contribution that has been made by Nick and look forward now to the discussion from the comments.
That's great, Paul. Thanks very much. I also value Nick's contribution. Nick, do you have any comments that you would like to make on what Paul said, or then I can just move to the chat?
Probably a couple of things. One on the sort of the COVID example of I guess adverse effects on company profits. I noticed, first of all, that the bank's profits reduced, but they still made profits. So they didn't do too badly. And obviously other companies, the measures that the government took effectively gave them some relief in a different way, obviously, from the adverse effects of the pandemic. So in effect, that was a sort of not quite a windfall tax in reverse, but getting close to it. The COVID relief measures, I would say. I think also I mean, one of the things I was thinking about when looking at interest limitation rules is in the context of the tax relief for landlords is one of the arguments that's often put regarding the treatment of rental properties, landlord's income is that it's a business. So whether or not you accept that, you could at face value say, well, if it is a business, then you should be subject to the same interest limitation rules as any other business. And if you were to introduce interest limitation rules 30%, for example, across the board, then that would also apply to landlords. Now that would be an interesting debate to have, I think.
Thank you for that, Nick. The other thing I'd add is not always were those windfall losses unusable. They, the second you make profits, they stop paying tax. Right, well, thank you, gentlemen. I will now move to the chat. First question for you, Nick, from Heather. Although 17%, and this is 17% of the total tax take coming from company tax, is greater than other countries, does New Zealand have more international companies, so less money stays in the economy? So are New Zealand companies more likely to be foreign owned?
I don't know the answer to that off the top of my head, but I would guess probably yes, because simply the way that our economy is structured, and the number of overseas companies in a relatively small market operating here. So I don't have a number, but my sense is that probably that is correct.
Yeah. And I would probably also think that given that we have that spread between the company tax rate and the personal tax rate, there's probably a lot of personal income in those companies. Okay, next, this is someone's point of view, so I'm putting it to you for your view, Nick. Jay Yeti said, I would like to add the concept of a levy of 0.5% on both sides of all transactions. I guess that's possibly a bit like GST that doesn't net out. A type of financial transactions tax that would amount to 1% of total annual bank turnover as a replacement for income tax, company tax, and GST. Do you have a view on that, Nick? I might also put that to Paul, if you want to answer.
I mean, it sounds a bit like the financial transactions tax, which is also been
exactly like it.
Yeah. So, and that has never. I don't think that's ever actually seen the light of day. The closest I think that I've seen to it is stamp duty in the UK on share transactions. I mean, I don't know. One would have to look at what kind of yield you could expect from that kind of transaction, how easy it would be to collect, how easy it would be to avoid. I mean, there are so many multiple questions arising from such a radical change in the tax regime that it would require a great deal of research to even ascertain whether it was feasible. I mean, if you would look at something more limited, such as a financial transactions tax or stamp duty on shares or something of that ilk, then that could be potentially I mean, probably not so much in New Zealand because the financial market is tiny compared with other countries, but it might raise some money.
Okay. Going back to landlords, this is kind of a combination of the tail end of the John Kenton questions comments. The business argument for landlords, so the reason they should have the interest deductions, that the gain is also an equivalent part of the investment and so should be equally taxed, even if we would say as ordinary income rather than capital gains. So do you have a view on that, Nick?
I can see where that comes from, in that in a sense is an extension of what the business model is. So it's not off the wall or unreasonable. I think it would be potentially more effective to have proper capital gains tax, fully fledged capital gains tax regime, or a bright line test, or a combination of the two, to capture all of that. But I mean, going back to what I was saying earlier, I think restricting interest deductions and having a logical reason for doing it is potentially a discussion that could be had in the context of, because it's a very fraught issue, obviously, tax relief for landlords. It's very political, and that might be a way forward.
Cool. Next one from our friend John. Has Inland Revenue, as far as you're aware, published any analysis of company tax comparable to that for trusts? Because the feeling is that that might answer some of the closely held company profit retention issues. So are you aware of anything that compares company taxation to trust taxation?
I'm not aware of them publishing anything. It doesn't mean to say that those studies haven't been done internally, and I think the only way to find out is by making an OIA request for that kind of information, which I haven't done, but certainly could be done.
That's right. Okay. Heather has also suggested, going back to landlords, that she's got reinstate landlord tax. I think that means reinstate the elimination of deductions, but to take away or write off GST on new builds. The comment is, it's ridiculous that we pay GST on new builds but no tax on housing purchase, as in stamp duty. Do you have a view on that?
Well, this will probably be an unpopular view among a lot of people in New Zealand, but I actually quite like stamp duty land tax. And the reason I like it is it's easy to collect, very difficult to avoid, and reasonably predictable, because a certain number of houses generally change hands every year. And if you look at the Australian example, it doesn't seem to massively affect the turnover of properties. Yeah, I mean, I'm not sure about the GST point on new builds, but I would make a plug for stamp duty land tax, definitely.
Okay, noted. And we'll do one final question, and then we'll do the outro. This is our friend John again. When we were talking, this is with reference to your slide on fuel prices and fuel returns. Does the fuel company's argument that price rises so that they can buy more stock at the higher rate make sense? Because I think we've all heard that, oh yes, we have to put our prices up because when we buy it back, it's going to be at a higher rate. What do you think of that argument?
Well, it's reasonable if you were to see the mirror image on at the other end of the cycle, if you like, when things return to normal, but you never do. I can see why. The replacement cost, yes, is going to be at a higher price, but then you never this is why there is still a windfall, I think, because you don't tend to get that big gain at the other end when things return to normal. It's much more gradual. So yeah, you can accept that argument, but you have to do the same at the other end. That your replacement cost is actually going to be lower as market price of crude oil, for example, declines.
No, excellent, Nick. We'll call that the last question. So at this point, it comes to me to thank Nick and Paul for your insights and discussion that we've had today. I've appreciated it. And Nick and I, before we started, were hoping that we could make it all reasonably accessible to non-specialists, and that's for others to determine. But I think we spoke in ordinary words occasionally, Nick, so I think we can give ourselves
hope so.
Yeah, and want to thank everyone for coming along, and thank everyone, and apologies to John Canton for not getting to all his questions and comments. Now, if you've enjoyed this session, there are other ways to get involved. There are 3 things that you can do. There's sign up to get involved, and that's in the chat. You can fill out the volunteer form, which is also in the chat, or in the email that will be sent to you when you sign up. And again, for those who want to, Tax Justice Aotearoa would love a donation. But last time I looked, weren't not a charity. It would be it wouldn't be a tax deductible or tax rebatable donation, but still valuable. Now, in the upcoming seminars, if you enjoyed this, in 2 weeks' time, the 11th of August, there'll be a session on Tax Justice Aotearoa's policy on wealth taxes and wealth transfer taxes, which is very relevant given Paul's comments today. That will be led by Bill Rosenberg and Louise Delaney, both stalwarts of the Tax Justice Aotearoa movement. Then this series will conclude with a panel discussion on the 25th of August about how the current New Zealand tax settings, Tax Justice Aotearoa's policy proposals, and a compare and contrast with other countries are doing. And if you sign up to the mailing list, you'll receive notifications to that. So again, I thank our speakers, Nick and Paul, and thank you to all for attending and contributing. And we hope to see you again at the next session on the 11th of August.